The Little Book of Value Investing by Christopher H. Browne, Margin of Safety. Welcome to yourbooksummary.com. Benjamin Graham was a prudent investor who always looked for companies he could purchase for less than their intrinsic value. He believed that the difference between the purchase price and intrinsic value provided a cushion against bad judgment or unexpected events that might harm the company. Graham's fundamental principle was to buy stocks at a price that did not exceed 2/3 of their intrinsic value. This strategy and his insistence on a margin of safety had some accidental but significant benefits. One of the benefits was that intrinsic value typically increases over time. This means that the investor profits when the intrinsic value rises, since the stock price also increases. Additionally, suppose the market recognizes the intrinsic value of the stock. In that case, the investor earns twice. The stock price rises to the intrinsic value, generating a profit, and the intrinsic value increases over time, generating another profit. Investors need to exercise patience and avoid making decisions based on emotional reactions. The stock market is volatile, and prices fluctuate greatly, making it difficult to predict the best time to buy or sell. Market timing is generally not a successful strategy, as predicting the market's future is extremely challenging. However, value investors can benefit from a margin of safety by purchasing stocks at a price that is significantly below their intrinsic value. This strategy often leads to buying opportunities when other investors sell during market downturns. In addition, value investors tend to avoid companies with high debt levels, which can increase risk and limit management's decision-making abilities. High debt levels can make it difficult for companies to weather difficult times, as the expense of debt service can be a constant burden. Additionally, creditors may significantly influence management decisions, which can limit the company's potential for growth and success. I hope you found the information about The Little Book of Value Investing by Christopher H. Browne. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I'll see you in the next video.